Chapter 5 Opportunity Cost and the Growth of Capital. In this chapter, I argue how capital can be compared over time through the principle of opportunity cost, deriving from the growth of capital. This will introduce the moral importance of time and how aspects of the present can be more or less important than aspects in the past or future. We will be able to calculate what property and capital is worth forgoing in the present for property and capital in the future, which is critical to our moral decision-making. The principle of opportunity cost is fundamental to the moral question of how to allocate property. Many argue that if an individual can afford to do something, then it follows that they should. However, this is ignorant of the opportunities foregone by spending those resources. We may be able to afford to do one thing, but not a million things. How is one type of allocation of capital any better than another? Which of those million allocations should we choose to allocate our present capital towards? By analyzing the growth of capital into the future of each of these choices is how we can determine the best opportunity available when allocating capital in the present. Also, the principle of opportunity cost is instrumental to the calculation of how much capital is worth forgoing in the present for property that is productive, i.e., produces capital, into the future. This will be important in understanding the capital of certain types of property like bonds, securities, projects, companies, and even human beings, which will be discussed in the next chapter. If you had to choose between having $10,000 of money now or $10,000 of money a year from now, which would you prefer? What about any form of property and not just money? Would you prefer having a car now or having the same car a year from now? Would you prefer having a house now or having the same house a year from now? Nearly everyone would prefer the property now rather than later. Why? There are several factors of which include the depreciation, expense, and uncertainty of the property. The property could depreciate over time if used, or, in the case of money, inflation can cause it to be less valuable. Owning the property may incur an expense to maintain it rather than if we didn't own it. And perhaps there is a degree of uncertainty that either the property as promised won't be received in the future, or we won't be around in the future to use it. But there is a fourth factor. If we were to assume no depreciation, no expense, and absolute certainty, we would still prefer the property now, and this preference is principally due to opportunity cost. We have more opportunities with property now than we have with the same property in the future. With the property now, we can use it now, where we would have to wait to use it if receiving it in the future. Worst case scenario, if we had no good use for it now, we can hold on to the property for a year and be in the same spot as if we were to receive the property a year in the future. By choosing to receive property in the future rather than the present, we forego the opportunity to use it in the present. That is our opportunity cost. It's possible that within that time span, we could use that property to make us better off in a year than simply having the property in the future. I propose that the opportunity cost of receiving property in the future instead of the present is the expected growth of capital foregone from use of that property in the present. The mechanics of calculating this opportunity cost will be elaborated further in this chapter. So let's ask a more interesting question. If you had to choose between having $10,000 of money now or $12,000 of money a year from now, which would you prefer? It depends. It depends on the opportunities available to you. What present opportunities do you forego by receiving the $12,000 in the future versus what opportunities you have by receiving $10,000 in the present? Let's look at two scenarios. 1. Perhaps Frank is planning to save up enough money to start a business in the next few years. Let's say he needs $100,000 total. And the $12,000 in a year gets Frank closer to the day of starting his business than receiving the $10,000 in the present. 2. Perhaps Jane and Will are expecting a child soon and are looking to purchase a house in the next few months. They would rather have the $10,000 now so that they can get a better deal on interest rates by providing a bigger down payment for a house they expect to buy soon. So, when faced with the choice between less money in the present and more money in the future, really the choice we should make is the choice that gives us the better opportunities. The production of capital would posit the better opportunity as the choice with the greatest capital produced. So, let's go back to the two scenarios and analyze how each choice can lead to greater capital produced. Looking at scenario 1, let's say Frank has a savings in a mutual fund, currently at $50,000, which has been growing in capital on average at 5.49% annually. To the best of his knowledge, the mutual fund is his best option for growing his savings to get to $100,000 as soon as possible. So if he makes the choice to receive $10,000 in the present, he would place it in the mutual fund, which he expects to grow at 5.49% over the year. So at the end of the year, he expects to have $10,549 if he chooses to take the $10,000 in the present. We can see here that it is preferable for Frank to choose the $12,000 a year later, since he expects that choice to end up with more capital at the end of the year than taking the $10,000 in the present. Looking at scenario 2, let's say Jane and Will have savings of $20,000 that they are willing to put towards a down payment. They are looking at houses and mortgage options and know that if they put $30,000 towards a down payment rather than only $20,000, they can reduce the fixed interest rate on a 30-year mortgage of $200,000 from 5% to 4.5%. Table 1 of the appendix shows the calculation on fixed payments and accrued savings over 30 years for a series of choices. Let's look at 3 choices. Choice 1. They take the $10,000 now, but rather than put it towards the down payment, they invest in a mutual fund that grows at 5.49%. Choice 2. They take the $12,000 a year later and put that into the 5.49% mutual fund. Choice 3. They take the $10,000 now and put that towards their down payment and invest the savings they gain between the fixed payments for a 5% mortgage and a 4.5% mortgage into the 5.49% mutual fund. When looking at the end of 30 years, choice 1 ends up with $49,698 in savings. Choice 2 ends up with $56,534 in savings. And choice 3 ends up with $92,028 in savings. We can see that choice 3 is the best because it ends up with more savings, more capital, over time. So, for Jane and Will, we can see that taking the $10,000 now is better than $12,000 a year later. How much would the money need to be a year later for it to be worth Jane and Will to take the money a year later rather than the $10,000 now? In the last column of Table 1, we see that it would need to be as high as $19,534 for them to be indifferent between either choice. So we can see that depending on person's opportunities, their situation and nature, different choices can lead to different outcomes in capital. Jane and Will had better opportunities for the money in the present than did Frank. For the production of capital, in order to determine the best option, we must understand the expected future outcomes of those options and choose the one that leads to the greatest capital produced. We introduce the concept of investing savings into a mutual fund that grows at 5.49% annually. What is a mutual fund and why 5.49%? A mutual fund is a managed fund that takes people's money and savings and invests it in a portfolio of securities, which can include the bonds and shares of companies. These companies either pay out capital, usually money, to their bondholders and shareholders in the form of debt payments, dividends, or stock buybacks. Or they reinvest such capital to grow their earnings, increasing their valuation. How earnings and valuation are connected will be explained later in this chapter. Either of these produce a return on investment, resulting in the growth of capital invested. 5.49% is my estimate of the historical growth of capital for investing in a low-fee mutual fund of the S&P 500, a collection of 500 publicly traded companies which cover roughly 80% of the total U.S. equity market. As shown in Table 2 and Figure 1 of the appendix, when accounting for the inflation-adjusted historical price of the S&P 500, the dividends given by the listed companies, the effective capital gains tax, and a low mutual fund fee, an investment has grown an average of 5.49% per year for the past 90 years. This is a little conservative because I assume capital gains tax annually rather than over a longer period of time, which can end up producing up to about 1% more growth per year if such an investment was held for many decades prior to selling. Of course, past trends do not ensure future outcomes, but they do help predict them. The value of equity can swing wildly year to year, far more than 5.49%. But when you are looking at investing over many years, and possibly decades, you are more assured to have a growth of capital closer to that of 5.49% annually than if you only invest for a year or so. If you want to invest short-term, you are taking on more uncertainty in your future outcome, where you could easily be down 10% or up 10%. For the past 90 years, these companies have been able to organize property productively such that they have produced capital on average at 5.49% annually. This 5.49% is not guaranteed indefinitely. It is such that the nature of these companies, combined with the nature of the society in which they operate, have been able to produce such an amount. If the nature of these companies changes, or the nature of society under which they operate changes, the next 90 years may look very different, for good or for worse. Of course, you don't have to invest in just an S&P 500 mutual fund. That is just one opportunity available to you to invest your capital towards, of which there are a near infinite amount of possible investments you could choose from, of which you may want to choose from based on your knowledge of such investments. The reason why we use the term opportunity cost for property received in the future rather than the present is because we forego the opportunity of using the property in the present. By understanding our opportunities in the present, we can subsequently discount the present value of property to be received in the future. We can discount the capital of property received in the future by the expected growth of capital by that time in the future, such that the present capital willing to forego is equal to the expected capital received in the future divided by 1 plus the percent expected personal growth of capital divided by 100%. This is capital, not necessarily money. Going back to how inflation or deflation can change the capital of money, if we expect to receive a specified amount of money in the future, we would subsequently need to also account for the expected amount of inflation or deflation by that time point, such that the expected capital of money received in the future is equal to the present CPI divided by the future CPI multiplied by the money received in the future. So, if inflation is expected into the future, the capital of the money received in the future should be subsequently lowered. For simplicity, the following examples will assume zero inflation or deflation.